What if I told you that your perfectly safe, highly diversified, totally responsible retirement portfolio is actually a massive high-risk bet on just three tech companies?
Yeah, it is the uncomfortable truth of modern investing. I mean, we really think we're buying the entire market, but the data suggests we've accidentally become the most concentrated, high-wire active traders on Wall Street without even realizing it.
Right. And if you're listening to this right now, looking at your screen as we map out portfolio strategies for 2026, you are probably feeling that exact anxiety.
Oh, absolutely.
You're looking at Nvidia's current price or like Apple's trillion-dollar market cap and thinking, I missed the boat. Like if I buy into a growth fund today, I'm just buying at the absolute top of a bubble.
Which is exactly why we need to look under the hood, because the diagnostic landscape for exchange-traded funds, or ETFs, has become incredibly murky lately.
Yeah, it really has.
We rely on these funds to do the heavy lifting for us, but the labels on the outside, they rarely match the mechanics on the inside anymore.
So true. Well, welcome to another deep dive. Today we have a very specific mission. We are navigating the crowded, uh, highly lucrative, and surprisingly opaque world of growth ETFs for 2026.
Right, we're trying to figure out what is actually driving the numbers, and more importantly, what is the best actual deal based on today's prices,
hmm
looking at PE and price-to-book ratios.
And the numbers we are dealing with are massive. We have synthesized a literal mountain of data for you today.
Yeah, we're pulling from the extensive performance rankings over at Sound Mind Investing, plus deep dive analytical articles from the Motley Fool and Optimized portfolio.
We also grabbed some really sharp quantitative YouTube analyses, and we're even cracking open Vanguard's literal portfolio composition files to see exactly where your money is going.
Exactly. Our goal today is to cut right through the noise. We want to look at the mechanics of these top 5 or so funds based on past performance, not just what they hold, but how they operate.
Right, to help you, the listener, figure out what truly belongs in your portfolio to weather the specific economic climate of 2026. Okay, let's unpack this.
Let's do it.
To understand growth investing right now, we have to start by looking at the absolute heavyweights, the titans of the space. I mean, we're talking about large cap growth ETFs that are just entirely dominating the market.
So big 3.
Yeah, specifically the big three. So that's the Vanguard Growth ETF, ticker VUG, the Schwab US Large Cap Growth ETF, ticker SCHG, and the Invesco NASDAQ Q100 ETF, ticker QQQM.
Right, and these 3 are the foundational building blocks for millions of investors. If we look at the data over the past 10 years to establish our top performers, VUG has averaged roughly 18% per year.
Wow, 18%.
Yeah. And SEHG has done slightly better, averaging 18.6% per year. But the index tracked by QQQM, which is the NASDAQ 100, has averaged an incredible 20.1% per year over the last decade.
I mean, just think about the compounding on a 20% annual return. It is phenomenal.
It really is.
But it's not just the sheer returns that make these attractive to analysts, right? It's the structural costs. When you look at mutual funds from a decade or two ago, you were paying these hefty management fees just for the privilege of being in the fund.
Oh yeah, 1% or 2% sometimes.
Exactly. But today, both VUG and SCHG have an expense ratio of just 0.04%.
It's a profound shift in how retail investors access wealth building. I mean, really.
To put that 0.04% in perspective, it means that for every $10,000 you invest, you are paying exactly $4 a year in fees.
That's nothing.
Right. You are essentially buying a world-class, multi-billion-dollar portfolio for the price of a single fast food cheeseburger per year.
I love that analogy.
Now, QQQM is a bit more expensive at 0.15%, so, you're buying 3 or 4 cheeseburgers. But its historical long-term returns have outpaced the others.
Right, which for many quantitative analysts justifies that slightly higher toll at the gate. But we cannot just look at past performance and assume the future will look exactly the same.
No, definitely not.
We have to ask why these funds are performing so well and what mechanisms are driving that 18 to 20% return. So we opened up Vanguard's portfolio composition file for VUG to see exactly what is inside.
And what did you find?
Well, the reality is that the performance is overwhelmingly driven by the Magnificent Seven,
Right.
the mega cap tech giants.
Yeah, that's the theory of the broader market right now. But when you actually open up those files, the level of concentration is staggering.
It's huge.
Inside VUG, which is ostensibly marketed as a highly diversified broad market fund holding over 160 different companies, NVIDIA makes up a massive 13.22% of the entire fund.
Just NVIDIA alone.
Right. Apple is 11.49%. Microsoft is 9.59%.
So just those three companies account for nearly 35% of the entire fund's value.
It's crazy.
And when you add in Amazon, Meta, Tesla, and Alphabet, you're looking at an incredibly top-heavy structure.
And I have to push back on the financial industry's terminology here because it feels a bit, I don't know, misleading to the average investor.
How so?
Well, if almost a third of your money in VUG is going into just 3 tech companies, are you really buying a diversified ETF, or are you just buying a Magnificent Seven fan club membership that just happens to come with 150 tiny, insignificant tag-along companies?
That is a completely valid critique. And it really comes down to understanding the literal mechanism of how these funds operate.
Okay, break that down for us.
Sure. So the vast majority of these ETFs are market capitalization weighted. That means the larger a company gets in the real world, the bigger its slice of the ETF pie becomes.
So structurally, a market cap-weighted fund is literally forced to buy more of a stock precisely when it's at its most expensive.
Precisely. It is a momentum machine. As Nvidia and Apple have exploded in value, the passive index funds are systematically forced to buy more of them to maintain the correct weight.
Wow, so success breeds concentration.
Exactly. The funds have effectively been consumed from the inside out by their biggest winners. Which brings us directly to the hidden catch of modern growth investing, which is concentration risk and severe sector bias.
Right, because if you look at the sector weightings, the illusion of broad diversification completely shatters.
Yep.
SCHG is 48% allocated to the technology sector. VUG is 62% tech. And QQQM is sitting at a whopping 64% tech.
And this becomes a serious portfolio construction issue for you, the listener, if you also hold standard benchmark funds.
Like the S&P 500.
Exactly. A lot of investors will buy something like the S&P 500, say the SPY or VOO ETF, thinking that's their core safe investment. And then they buy VUG or a CHG on the side for a little extra growth.
But the data shows they are buying the exact same things twice. The overlap is huge.
It's massive.
VUG overlaps with the S&P 500 by 59%, SCHG overlaps by 55%, and QQQM by 52%. You aren't diversifying, you're just doubling down on the same handful of mega-cap tech stocks.
Right, you are amplifying your risk while falsely believing you are spreading it out. And what's fascinating here is how the quantitative analysts measure whether that amplified risk is actually worth it for the investor.
Oh, right, using the Sharpe ratio.
Exactly.
I always look at the Sharpe ratio when evaluating these funds because returning 20% doesn't mean much if you're taking on casino levels of risk to get it. A ratio near 1.0 means you're being properly compensated for your anxiety, doesn't it?
It does. It essentially measures how much excess return you are getting for the extra volatility or risk you are enduring.
Right.
If a fund gives you huge returns but makes your stomach drop every other Tuesday with massive price swings, its Sharpe ratio will be lower. According to the quantitative analysis we reviewed, VUG sits at a very strong 0.88.
Okay, not bad.
SCHG is at 0.92, and QQQM leads the pack at 0.95.
So QQQM is historically giving you the most optimal bang for your buck when it comes to the risk you're taking. Even with its slightly higher fee, it has perfectly ridden the wave of tech dominance.
It has.
Yeah.
But if we are talking about pure, unfiltered momentum, and an investor really just wants to lean into that concentration risk rather than fight it.
Oh, boy.
Yeah, we have to look at the absolute extreme outlier in our data stack today, the VanEck Semiconductor ETF, ticker SMH.
Ah, SMH. Yeah, while the broad growth funds are returning 18 to 20%, SMH posted an absurd one-year return of over 50%.
It's wild.
It has over $19 billion in assets, and its 3-year return is over 50% as well.
But we have to explain the mechanism behind that kind of explosive growth, because it is the ultimate double-edged sword.
For sure.
SMH is highly concentrated entirely in companies that design and manufacture semiconductor chips. You know, the physical hardware powering the AI revolution.
Right. So when you buy SMH, you aren't just betting on broad technology adoption. You are betting on a single, specific physical bottleneck in the global supply chain.
Exactly. You are taking on massive geopolitical risk. The companies in this ETF, like Taiwan Semiconductor Manufacturing Company or ASML in the Netherlands, they rely on incredibly fragile global trade routes.
Yep.
If there is a geopolitical issue in Taiwan or a sudden shift in AI hardware demand, the entire supply chain chokes.
So that 50% upward swing can become a 50% downward spiral just as quickly because there is no safety net of other sectors to catch you.
Exactly. It represents the absolute peak of concentration risk.
Okay, so if the large cap ship is structurally biased and top heavy with tech, and the highest performing outlier is a high wire geopolitical act, Where is the escape hatch for an investor who still needs growth in 2026?
Well, the data points away from the giants and toward two fascinating alternatives: small cap growth and a surprisingly effective cash-driven strategy.
Let's look at the small caps first. Based on the optimized portfolio and Motley Fool data, a standout alternative is the Vanguard Small Cap Growth ETF, ticker VBK.
Right, VBK.
It has around $34 to $40 billion in assets, a super low fee of just 0.05 to 0.07% depending on the current prospectus, and it tracks the CRSP US Small Cap Growth Index.
To understand VBK, you have to understand its selection mechanism. It doesn't just buy every small company blindly.
Right, it has a filter.
Exactly. It actively filters for the top 50% of small cap stocks that show the best earnings growth outlooks and strong returns on assets. It is trying to find the next big thing before it becomes a big thing.
And it's crucial to look at analyst forecasts here, right? Because small caps rely heavily on borrowing money to fund their growth.
Well, absolutely.
If forecasts suggest a lowering interest rate environment for 2026, small caps suddenly have explosive upside because their debt becomes cheaper.
They do. But, small caps feel like too much headache for the average investor sometimes.
Really?
Why? Well, one bad economic report, a little bit of inflation data, and they are usually the first to tank because they don't have the massive cash reserves of an Apple or a Microsoft to weather the storm.
That's true, they don't, but that lack of size is their biggest advantage.
How so?
Well, think of Apple like a massive ocean cruise ship. It takes billions and billions of dollars of institutional money to turn that ship's stock price just a few degrees.
Right. Whereas a small cap is a speedboat.
Exactly. Just a little bit of buying interest flows in and the stock price whips around instantly.
That's the perfect way to look at it. And if we want to talk about finding the best deal based on today's prices, we really have to look at the PE ratios. The price to earnings ratios across these funds.
Let's break down PE for a second because I think people hear that acronym and their eyes just glaze over.
Yeah, they do.
But it's actually just a simple measure of what kind of deal you're getting today. Think of it like buying a business in your local town. If a coffee shop makes $10,000 a year in pure profit, are you willing to pay $400,000 up front just to buy it?
Probably not.
Right. Because that is a PE of 40. You are paying $40 for every $1 of actual earnings. And that is essentially where mega-cap tech and funds like QQQM are hovering right now. You are paying a massive, massive premium for future promises.
And compare that to small caps or value funds, where you might only pay $15 or $20 for that same $1 of profit.
Big difference.
With mega-cap growth funds, investors are paying that premium because they believe the absolute dominance of tech is a sure thing. Yeah. But with small caps and VBK, the PE multiples are generally much more reasonable. You're dealing with more raw potential.
The risk premium is higher because they're speedboats, but the potential ceiling for capital appreciation is massive if those earnings forecasts actually materialize.
Exactly. VBK offers a highly diversified way to capture that energy without having to handpick individual small companies, which is notoriously difficult.
Here's where it gets really interesting, though.
Okay, I'm listening.
What if you want growth, but you are completely exhausted by the high PE ratios of tech, and you don't want the wild volatility of small cap speedboats?
Is there an option for that?
Yeah, the deep dive data from Motley Fool and Optimized Portfolio brought up a wildly different approach that has been quietly killing it. The Pacer US Cash Cows 100 ETF, ticker COWZ.
COWZ. That is a brilliant piece of financial engineering because it flips the traditional growth script completely upside down.
It really does.
Instead of chasing companies with hyped up momentum or incredible future promises of AI dominance, COWZ looks strictly at the present reality of the balance sheet.
Right.
It targets the 100 large cap stocks in the Russell 1000 with the highest free cash flow yields.
And for you listening, free cash flow is exactly what it sounds like. After a company pays its employees, keeps the lights on, and maintains its factories or servers, free cash flow is the cold, hard cash left sitting in the bank account at the end of the day.
Unencumbered money.
Yes, unencumbered money. They can use to pay dividends, buy back their own stock, or acquire rivals.
And free cash flow yield is simply that leftover cash divided by the company's total market value. A high yield means the company is a cash-generating machine relative to its price.
Which is exactly what you want.
Right. What the analysts note is that prior to 2020, large-cap growth dominated everything. But since then, this cash cow strategy has been incredibly impressive. It offers a totally different risk and return profile compared to a VUG or a QQQM.
But how does having high free cash flow actually protect the investor? Let's talk about the mechanism of how cash buffers the downside.
It comes down to independence.
Okay.
If interest rates stay high or inflation spikes in 2026, tech companies that rely on cheap debt to fund their 10-year growth plans suddenly look incredibly shaky.
That makes sense.
But a company inside COWZ has cash on hand today.
Mm.
They don't need to borrow at terrible rates. In fact, if the broader market dips, these cash-rich companies can actually step in and buy back their own stock at a discount.
Which artificially reduces the supply of shares and engineers a higher stock price for the investor.
Exactly. It's acting as a massive counterweight to tech.
Yeah.
Because it's screening for cash flow rather than market hype, we see that reflected in its valuation metrics.
Right. If we look at a prompt to find the best deal based on today's price, COWZ is phenomenal. Its PE ratio is drastically lower than VUG or QQQM.
And we also have to look at the price to book, or PB ratio.
Right, another important metric.
This is a metric that looks at the actual net assets of a company. If a business went bankrupt tomorrow and they sold off all the servers, the real estate, the inventory, what is it intrinsically worth?
Yeah.
Tech funds have skyrocketing PB ratios because their value is mostly in intellectual property, algorithms, and future hype.
You are paying a premium for an idea, not a physical asset.
Exactly. But CLWZ targets fundamentally sound companies with hard assets and real cash. Its price-to-book ratio is incredibly attractive for investors looking for a deal in an otherwise overheated market.
So you are getting growth, but it's driven by fundamental profitability today, not speculative potential tomorrow.
Precisely. If you are terrified that the tech sector is a bubble, CLWZ is essentially a portfolio of highly profitable, unglamorous businesses that just quietly print money, regardless of what the AI algorithms are doing.
And that is the ultimate key to structuring a portfolio for 2026. It is not about blindly finding the single best ETF, because best is entirely subjective.
It really is.
It depends entirely on what the rest of your portfolio looks like, what your personal risk tolerance is, and what kind of economic weather you are trying to prepare for.
Precisely. The analysts make it clear you have to align the specific mechanics of the fund with your forecast of the future.
So let's bring this all together for you, the listener. If your forecast believes the Magnificent Seven will continue to utterly dominate the global economy, and you want a slight, highly diversified tech tilt with fees, the price of a cheeseburger, VUG, or SCHG are rock-solid plays.
Absolutely.
If you want the high-octane, highest historical return of the NASDAQ 100, and you don't mind a slightly higher fee to ride the purest tech momentum, QQQM is the historical winner.
But if your diagnostic X-ray shows that your portfolio is already dangerously overloaded with Apple and NVIDIA from your standard S&P 500 funds, you have to look at the escape hatches.
Right.
You look to the speedboats of VBK to capture the upside of a favorable interest rate environment, or you anchor yourself with the fundamentally sound, high free cash flow companies in COWZ.
It's about buying a fundamental deal today to offset your speculative tech exposure tomorrow. You cannot just buy a fund because it has the word growth in the title.
No, definitely not.
You have to know how it is fundamentally weighted and what it's actually buying with your money.
You know, if we connect this to the bigger picture, it actually brings us full circle to a somewhat terrifying structural question about the modern stock market.
Terrifying how?
Well, we opened by talking about how passive investors might actually be active traders. We have spent the last decade praising the benefits of low-cost passive index funds. But right now, trillions of dollars are automatically blindly pouring into these passive funds every single month via 401ks and retirement accounts.
Right, the automatic biweekly paycheck deduction that millions of people don't even think about.
And because these broad funds are market cap weighted, the vast majority of that blind money is automatically funneled directly into Apple, NVIDIA, Microsoft, and the rest of the Magnificent Seven, regardless of their PE ratios or how expensive they are. So here is the question you have to mull over for 2026. If the entire global market is passively, automatically propping up just 7 companies, what happens to the structural integrity of your safe S&P 500 index if just 2 or 3 of those Magnificent Seven suddenly stumble on a bad earnings report?
That is a chilling thought.
Isn't it?
We have automated our way into a corner. We think we are buying the whole market, but we are really just building a massive fragile tower on top of a few microchips and smartphones.
It is the ultimate paradox of modern diversification. In our rush to own everything, we have all ended up owning the exact same few things.
And that is exactly why you have to look under the hood. So our challenge to you today is simple. Go log into your brokerage account,
Yep, do it today.
look at the top 10 holdings of your favorite safe ETF, make sure your financial x-ray actually shows what you think it shows, and that you understand exactly what mechanisms are driving your money.
Good luck out there.
Thank you for joining us for another deep dive, and we'll catch you on the next one.